Saturday, March 14th, 2020, Maneco 64, home of alternative economics and contrarian views. So, the derivatives market, the U.S. Treasury market, they're causing problems. They seem to be at the heart of the troubles in the repo market. Before I start and go any further, I want to explain to the layman, a layperson, a little bit about derivatives and repo. Many of you know that I worked in the derivatives market. I was a futures and options broker, which is an exchange-traded derivative. There are also over-the-counter derivatives. They're not traded on an exchange. Dealers, banks, they design these derivatives to tailor their clients. But in an exchange-traded derivative, the contracts are standardized. That's the main difference. The information is also made public. But one thing that is common amongst all kinds of derivatives is that people use them to leverage. You don't have to put too much margin to control a lot of a big notional amount of derivatives. We hear people talk about the fact that there's probably over 1,000 trillion of notional derivatives outstanding, or over a quadrillion. And they're most probably right. The Bank for International Settlements and the regulators changed the rules after the '08 crisis to make it look like there isn't as much outstanding notional amount, but it is more than a quadrillion, so it's huge. Seeing that the world economy is around 70 trillion a year. Yeah, derivatives and leverage. So that's one thing you need to understand. And this is the major problem of the system, is the leverage, is the hypothecation or even rehypothecation. It's the fractional reserve system. That's the heart of the problem, and that's why we're having problems now. That's why we always have financial problems, because people are greedy. What about the repo market? Well, the repo market is also another market where these financial institutions leverage even more. Why is that? Well, the basic explanation of the repo market is a market where, for example, you have a car that's worth $10,000, for example, but you don't want to sell the car for good. So you sell it to Mr. Smith for one day. He'll give you the $10,000. He's got the car as collateral. You take that $10,000 and for one day you put it on a horse that you think is a dead cert, and that horse makes you $1 million, right? And then the next day you buy back your car, give Mr. Smith the $10,000 plus, let's say, $100. That's the repo rate, for example, the $100 a day. So that's what is happening. That's what the repo market is, and basically is done on multi-billion basis. The primary dealers on Wall Street, City of London, they're mostly the too big to fail banks. There's also shadow banking institutions, hedge funds, mutual funds, all kinds of financial institutions using this market to leverage even more. Sometimes they take these proceeds and they put it in the derivatives market, which leverages it even more. Of course, this repo problem started back in September of last year. It's still ongoing, of course. So I think the derivatives and the leverage is causing the problems in the repo market. I'm going to reference now an interesting article I saw earlier this week, March 12th, in the FT. And this is right up my street, because I used to do these kinds of trades for clients. And to be honest, when I was in the markets, they weren't very common because they're very hard to make money upon these trades. And so I'm surprised that these trades are causing a big problem. I think it just shows that market participants are very complacent, and they think that they can just do things and that the central banks will come to their rescue. And that's what it looks like they're doing, of course. What is causing such fear in the US Treasuries market? Strange patterns have started to emerge in what is usually a haven at times of crisis. Yeah, and this week was amazing. The movements in Treasury markets, especially longer term, like 10 and 30-year yields. We saw recently yields in the 10-year drop from above 134 or around 150 all the way down to 31 basis points. And then this week we rose back to almost 1%. We've seen the 30-year go below 1% to like 72 basis points. We've seen it go up even over 30 basis points in a day. It's crazy. It's all over the place. It's supposed to be a safe haven, stable market. And believe me, when I worked in the bond markets like I did, that's the other thing. I worked as a futures and options broker. My specialty was the government bond market. So I did a lot of treasuries, a lot of German Bund futures, even Italian BTP futures when they existed before the euro. I did gilt futures, UK government bonds. I did French bond futures, the Notional. I did JGB futures. I did all kinds of government bond futures. So this is very familiar. So let's see what's going on in the US Treasuries market. And it's got everything to do with the repo market, because these actors in the market, they use the repo market to finance these operations. So FT says investors and analysts are warning about deepening cracks in the world's largest government bond market. Strange patterns have started to emerge, such as drops in the price of US Treasuries, a traditional haven, even while riskier assets such as stocks have been squeezed by fears that the C disease outbreak will spark a global recession. Some are warning that the patterns could lead to the unwinding of one of the market's most popular trading strategies, with potentially serious consequences. Such fears prompted the US Federal Reserve to announce a sweeping package of measures on Thursday to try to ease conditions, including pumping trillions of dollars into the financial system. So yeah, that's the repo announcement the Fed made, the $1.5 trillion. And so it's 500 billion of same day 1 month, 500 billion of same day 3 month, and I think 500 billion of forward 3 month. It's all very confusing for the person who doesn't follow financial markets. Even for people like me, there's just so much, all the different maturities, all the different settlements. Be as it may, they offered another 1.5 trillion potential. Doesn't mean that they're going to give it right away. It's what the market demands. But I guess it calms the market down to know that the Fed is there to hold their hands. So much for free markets, right? We hear a lot of people on Wall Street raging against, let's say, socialists, Bernie Sanders and people like that. And I'm not a defender of socialism or Bernie Sanders by any stretch of the imagination. I'm a free market, small government guy. But it's very hypocritical that Wall Street expects socialism for themselves when things don't go right. But when the general public wants socialism, they criticize it. So I don't get it. Anyway, let's keep going. How did we get there? So this is the next question. How come the Treasury market has gone from being a safe haven place to being a very risky place that could even cause a huge crisis? Well, I would say the underlying problem, of course, is greed, speculation, leverage. And why is this happening? Well, you have to blame the central banks themselves because they've instituted a policy of almost no rates, zero rates, negative rates. So these people need to leverage. It's like you. If you had $1 million to retire on and you got 8% from your government bond investment, you'd be okay. You'd be earning $80,000 a year income. You would leave the rest of your capital alone because you could live on your income. But if they told you you're going to earn like 1% or $10,000, you'd have to take some of that capital you saved and try to speculate with it. So that's the same thing that's happening in the financial system. So we have to blame the central banks for this. And ironically, they are providing the solutions, supposedly, right? So this is how we got here, right? Nervous banks and other dealers seeking to insulate themselves from swings in asset prices have pulled back from facilitating trades between investors. That's the repo market. The US Treasury market is normally a safe place for investors to shelter from sell-offs, but it has not been able to escape the onslaught of volatility. This has made it more expensive for investors to buy and sell treasuries as primary dealers retreated. Yeah, that's the other thing as well. The volatility that I talked about, the yields going all over the place, that widens the bid and offer spread. And why is that? Well, because if you are making a market, if you buy and sell things, if someone calls you on the phone, that's what a dealer does, and says, what's your price in the 10-year treasury? They can't ask you what's your bid and offer. They need to ask you where the price is. And because the dealer, they make a two-way price. The dealer will, of course, try to read how the other person on the other side speaks. He'll try to gauge whether the guy's going to buy or sell. But usually in a normal market, he'll say, well, it's 101 and 10/30 seconds bid at 10/30 seconds and a quarter offered. Because the market is calm. So if he gets hit on the bid or lifted from the offer, he can always get rid of that inventory quite easily and not lose any money. But when the market is moving all over the place, the dealers are going to make the spread a lot wider. And the people who use the treasuries and the futures to do these strategies, which we're gonna come up to in a minute, they can't do it anymore because the spreads are not as tight, and they're looking for very thin margins, of course, in these trades. With a lot of leverage. So when the bid and offer spread widens, it kills, and it makes their strategies worthless, or they start to lose money. Who is at risk from this situation of illiquidity in the treasury market? So according to this article, it says that deteriorating trading conditions have put particular pressure on relative value trades. Such trades seek to profit from small price discrepancies, the tight spread, between two assets that are almost identical. Hedge funds such as Millennium Management, Exodus, Point, Alphadyne, and Capula are among the most active players in this area. So there you go, the hedge funds, the greedy hedge funds that there's called hedge funds, but they're actually basically speculators. It's just a euphemism for highly leveraged speculators or gamblers. And this is what it has come down to: central banks bailing out gamblers. That's why we need to work on educating people so we can end the Fed and all the other central banks. You can get one of these in my Teespring store below, End the Fed. I've got equivalents for the Bank of England and the ECB. So one common trade is to buy cash treasuries and sell interest rate futures. Well, they mean treasury note futures. Or I guess they could do short-term interest rate futures. So that's called a basis trade. So that's the most common, it's the most basic strategy for this relative value trades. It's not even a very complicated strategy. It's what, as a futures and options broker, it's what I learned in the beginning about futures, that you can do a basis trade between the underlying treasury note and the future, the treasury note future, and the difference is the basis. And it's very hard to make money on that. And to be honest, I had very few clients who did basis trades, so I'm surprised that they're doing this. But at the same time, I understand why they're doing it, because it's one of the only things left where they think they can make easy money because they can leverage it. But now with the illiquidity in the market, it's basically destroyed these trades. Cash bonds have tended to trade slightly more cheaply than equivalent derivatives because they carry a higher capital charge for banks. This means that in normal conditions, investors can buy treasuries, sell the futures contract, and pocket the difference. In recent trading sessions, however, this trade has started to come undone. Yeah, it's a Ponzi scheme. If you have read about Charles Ponzi, he tried to do the same thing. It was a basis trade between foreign stamps and the foreign exchange market. Foreign stamps priced the exchange rate at a different level than in the foreign exchange market. And this was back in the 1920s, Charles Ponzi. And yes, you could make maybe 10 cents from buying a lot of stamps from Spain, for example, and doing the foreign exchange transactions against the dollar and the, how can I say, Spanish currency when you got the stamps, and you'd make 10 cents. But to make anywhere near where you'd have a big return, where you could promise people like to make a lot of money, there wasn't enough stamps in the world to do that. And that's the same thing that they're doing here. There isn't enough treasuries, underlying treasuries, or at least available treasuries out there to do these trades. So they're just leveraging it. I mean, the futures, of course, allows them to leverage it. So as I said, derivatives are at the heart of all the problems because they allow people, the modern day Charles Ponzi players or Ponzi schemers, to do what Charles Ponzi did with the stamps, the foreign stamps back then. Of course, it failed. And this is what we're seeing here. They thought that they could just do these trades and because they can leverage it and that the market would always be there perfectly for them. But with a little bit of volatility in the markets, we see that this is coming undone. So what has changed, the article says? Well, the decline in liquidity in cash treasuries has been more severe than in the futures market. Well, that's normal because, as I said, futures market, you can invent, you can trade as much as you want. You can create as many futures on treasuries you want. It's not based on reality. Of course, the treasury cash market, there's a limited amount of treasuries. This has resulted in the widening of the price difference between the two assets, with cash treasuries falling relative to futures. This might seem confusing given the treasury market has rallied sharply in recent weeks as investors have flocked to the safety of government bonds, but the cash market has not rallied as much as the futures market. So this is another example of how the paper market or the futures market a lot of times drives prices. And for those of you who are concerned about what happened to gold and silver yesterday, you can see that it's happening to treasuries as well. So the move in gold and silver yesterday had nothing to do with the underlying metal, with physical gold and silver. It had all to do with the futures. And I've heard from viewers that they're having a tough time procuring precious metals. Their dealers are telling them that they're going to have to wait a long time. I got a message from a viewer that said he even canceled his purchase because he wasn't going to get the coin right away. The result is that the value of the cash treasuries held by relative value traders has dropped relative to the value of the futures they sold. As these losses become more severe, traders could be forced to give up on their positions, dumping treasuries into an already dysfunctional market. This is an interesting comment here. This is from a guy in the markets, and I'm quoting him. "I am massively worried that institutions are panicking and are unwinding positions at will," said Tom DiGaloma, a managing director at Seaport Global Holdings, an investment bank. So what could happen next? On Wednesday afternoon in New York, says the FT, some traders became nervous after they spotted signs of heavy selling in so-called off-the-run treasuries, which are older issues of benchmark bonds that tend to be cheaper to buy and harder to sell. So what's an off-the-run treasury? Well, it's one that is not the benchmark for debt maturity anymore. And why is that? Well, because the U.S. Treasury is always issuing new notes. So they're not as liquid. So they're cheaper to buy sometimes, as the article says, but they're not as liquid. When you call a treasury dealer, and I worked in the cash market as well, when you say, what's the 10-year note, he'll give you the on-the-run price. If you want to trade an old 10-year, you got to specify it. This fan concerns that relative value hedge funds could be starting to suffer under the strain of the market's volatility. If that continues, expect treasury prices to drop. And we have seen treasury prices dropping. As I said, the yield has gone from around 32 basis points, the low we saw in the 10-year. We are now back to 1%. Yes, the yields are going up, but the prices are dropping. How big is this trade? It is hard to calculate precisely, but the growth of the repo market, where hedge funds obtain short-term cash loans in exchange for treasuries to juice their trades, juice just means to leverage even more, is a good barometer, according to Mark Cabana, an interest rate strategist at Bank of America. Daily volumes in the overnight repo market have roughly doubled over the past 5 years to $1 trillion. According to data from the Federal Reserve Bank of New York. The growth of trading strategies also caught the eye of regulators last year after a cash crunch sent repo borrowing costs soaring in September. The Bank for International Settlements then warned that highly leveraged relative value trading strategies may have exacerbated the situation. So the article finishes saying what can be done about it. The Fed moved to address the problem on Thursday, ramping up the amount of cash it will inject into the repo market for the third time this week to ensure funding markets are functioning. So that's where this $1.5 trillion comes in. And they also increased the not QE to, I think, 80 billion. So it's getting quite crazy. And next week, they're expected to announce at their meeting on Wednesday, real QE. A lot of people are talking about $1 trillion a year in real QE. We'll have to see. It will be QE4, I guess, officially, even though they've been doing these not QE, right? The U.S. Central Bank also said it would alter the types of bonds it will buy to address what it called highly unusual disruptions in treasury financing markets associated with the C disease outbreak. So yeah, this health crisis, is being used as a cover for reckless speculation, leverage, and I think it's outrageous. that the US taxpayer funds all of this. And how do you fund this? Because the Fed is just creating money out of thin air, of course, onto its balance sheet. Well, because it dilutes the currency that you're forced to use through legal tender laws. That's what it does. An extra trillion or 1.5 trillion of funny money will dilute the $20 note in your pocket, the $20 bill. The move could help, said Jay Barry, a managing director on the interest rate strategy team at JP Morgan, but he noted that policymakers have limited tools at their disposal. There is no immediate fix that can change it, he said. The only thing that will return some resemblance of normalcy to the deepest and most liquid market in the world is volatility decreasing. Do you think that's going to happen? Probably not. Will it be enough? This is the big question. Relative value traders have been significant buyers of U.S. Treasuries in recent years, helping to swallow the deluge of debt coming from the expanding government deficit. Analysts and investors fear that unwinding of these strategies could ricochet through the entire global financial system. So that's another reason why the Fed's going to do real QE. They're going to start buying these securities because these relative value traders or speculators or gamblers are trying to get out of these trades because the volatility in the markets has made these markets very illiquid. And these strategies are based on normalcy, right? Where markets are not volatile. There's another article, and I won't go through it. That was from yesterday. Fed speeds up purchase of treasuries to ease market strains. So that's to do with the 1.5 trillion they offered in the repo market on Thursday. That's what they're talking about. And they're also buying now up to 80 billion of not QE, right? It's all very confusing, I agree. Does this mean that they've created 1.5 trillion? No, they're just offering up to that amount. And but I think what this tells me is that the Federal Reserve will announce official QE on Wednesday. Their meeting is on Tuesday and Wednesday. On Wednesday, they will announce more QE, so to try to stabilize the Treasury market. Treasury market is where the whole financial system gets its risk-free rate of return from to price all other assets. And if this market is broken, it means the whole system's broken. So that's what's going on. What about the Fed's balance sheet? I said that I would speak about that earlier in the video. I made a video maybe a week ago or 10 days ago showing you this chart of the Fed's balance sheet, the fact that it was starting to top and that it coincided with the drop in the stock market. So lo and behold, as you can see here, this is from the St. Louis Fed. The Fed's balance sheet has started to increase. Last week, as of 4th of March, it was up to $4.2 trillion. They haven't updated this yet, but now the balance sheet is up to 4.31 trillion, and it's going to keep increasing even more. So is this Fed largesse going to help? Is the extra available 1.5 trillion in the repo market and the QE they will most probably launch next week help the market? Well, the verdict is still out. We'll have to see. One thing I would say, though, you need to be outside of this system as much as possible. You need to protect yourself with physical gold and silver. Yeah, I know gold and silver moved lower a lot yesterday, their paper prices. I wouldn't let that put you off. As I said earlier, it's really hard to get any physical gold and silver, or a lot harder than it used to be. And as I showed you from the example in this basis trade, this relative value trade, that the futures market and the underlying market can be completely different. And that's what I think is happening in gold and silver anyway. So let's keep an eye on the US Treasury market, on the repo market. I think it could be highly significant. And for those of you who have asked me in the past, when is the derivatives time bomb going to take place? Well, it's taking place already, because all these markets are highly leveraged and they all use derivatives. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to the channel as well if you haven't yet. And you can also follow me on Twitter, Facebook, BitChute, Steemit, and DTube. I wish you a great rest of the day. Take care. Bye.